everyone, a very good evening. You're watching a brand new episode of The Money Show on ET Now with me, Mubina Kapasi. This is the show, of course, where we get you your daily dose of personal finance lessons and carve your path to wealth creation. We help you save your money and spend it as well in the right manner. And let's not forget, also answer any questions or queries that you may be having. Remember, you can always connect with us by writing in on themoneyshow@etnow.tv. Let's tell you what we have lined up today on the show. We've got just a fortnight left of 2020. And yes, while it's a year that all of us cannot wait to say goodbye to, it's important that we have takeaways from this year as well. It has taught us a lot, especially in terms of money management. So let's ensure that we implement those lessons in the new year. How should you ensure that you create a proper portfolio for 2021, set your finances for 2021, especially if you are not able to meet your financial goals in the year gone by because of the pandemic. Later on the show, we'll also be talking about the fact that Bitcoin has crossed $23,000 for the first time. SEBI norms as well about how now fintech companies as well will be able to launch mutual funds. And finally, in our Spend with TMS segment, we're going to help you ensure that you don't overspend this holiday season with a very special guest. So action-packed day right here on The Money Show. But before we kick start with it, let's tell you what the big news headlines are at this hour. ET Now rounds up the year with one of the biggest corporate interviews. In an exclusive chat, TCS's CEO and MD Rajesh Gopinathan says cloud transformation is not a sugar rush and demand is here to stay. Also insists that the tech bellwether is poised to deliver double-digit returns going forward in this era of work from home. Gopinathan says that the office will be the place where people come for collaboration. He also shares his vision to operate as a talent cloud. Record highs once again. The Nifty is in uncharted territory above 13,700. Sensex near 46,900 as markets continue their ascent and pharma stocks lead the rally. Bitcoin sees a big bull run as the cryptocurrency surges past 23,000. Daily turnover in Bitcoin hits 400 to 450 crores as against 35 crores in March. The Bitcoin has almost tripled this year. Jubilant Foodwork hits a record high as the operator of Domino's Pizza and Dunkin' Donuts now makes a foray into the biryani business. Stock rallies 8% in the last 2 trading days. The Supreme Court allows the farmers' stir to continue, suggests that the centre should explore the possibility of holding the new laws. However, the government makes it clear they can't put farm laws on hold. The Apex Court also forms an independent committee for negotiations between the farmers and centre, but farmer leaders are against the Supreme Court's direction to form an independent panel. Even as India gears up for the vaccination drive, the WHO says countries in the Asia-Pacific region are not guaranteed to have early access to coronavirus shots, urges them to adopt a long-term approach to the pandemic. Meanwhile, French President Emmanuel Macron has tested positive for COVID. Well, that's of course the big headlines we'll be tracking for you all day today on ET Now. Let's kickstart the show then with our very first topic of the day. Like I told you, it's all about getting you set for a brand new year of 2021. Let's hope that it's a better one for all of us, the year 2021 compared to 2020. Okay, well, meantime, let's introduce on the show our guest for today, Shweta Jain of Investography. Shweta, it's a pleasure having you with us. Thank you so much for joining us today. on
Thanks,
ET
Meena.
now.
My pleasure.
So Shweta, to start with, what are the first few, at the end of the year actually is a great time for individuals to sort of look back, take a holistic view at their money, what went by in 2020, what went wrong, what was good, and then of course take steps for 2021. So what should be the first few steps one should take at the end of the year when it comes to their investment portfolio and their general money habits?
So I think one of the few things that people should do when it comes to their own money is save first. Most of us save what's left after spending. So we have to save first, put that aside, and then we can spend what you have to actually to spend, because otherwise we end up spending a lot of money. Whatever's in the bank gets spent. So I think that's first. If one thing people should change with regard to their money, one habit if they should change, it's saving first. I think this is the key factor. Second, which we've forgotten actually, our mothers used to do, our parents used to do, is budgeting our expenses. The more I talk to young couples today, the more I realize they don't budget their expenses at all. In fact, I know people who tell me their budget is, or their expenses are X. And if I ask them to tabulate and, go in detail, it'll be 3X or 5X. So it's that different. So they have absolutely no clue how much they're spending. So that is the second habit I would like them to change. Budget. When you write down your expenses, you realize how much you actually end up spending. Third, I would like people to change in 2021 is invest for the long term. A lot of us like investing for the short term or having our money liquid, which comes at a cost. So I think people should invest for long term. The only long term investments, otherwise, what happens are EPF, etc., which have lock-ins or which we are forced to do. So I would like people to do this, that they should invest for long term voluntarily and not by force. And the fourth thing that I'd like them to change is have an emergency fund. You never know when an emergency strikes. We've seen that this year more than ever. I think all of us were in this comfortable lull and, taking for granted that, we'll only see good times ahead. We are a generation of optimists. It doesn't bode well for times like this. While we should be optimistic about the future, we should also be realistic and have an emergency fund. Just be prepared. So I think these four things I would definitely change in 2021.
You mentioned one very important lesson that 2020 taught us, and that is having an emergency fund. But like I mentioned, many a times we want to look back and look at the entire year, and I think that's a wise thing to do. Reflect on the mistakes you made, the things that you did right. But 2020 has been full of lessons, especially because we encountered a health crisis, followed by an economic crisis. A whole lot of people lost their jobs, businesses were disrupted, they were unable to pay loans and what have you. What do you think are some of the lessons that 2020 taught us that we should ensure we keep with us and implement for the rest of our lives?
So I think the first lesson that 2020 taught us was to expect the unexpected. I would like to take an example of The Handmaid's Tale. It's something that I saw on Netflix late last year, and I would think, how do people live like this? Sort of quarantine, and the next thing I know, a couple of months later, we are in lockdown, we are in quarantine. There is a pandemic. So I think expect the unexpected, something that we've never imagined in our lifetimes, in our parents' lifetimes. We've seen. So we are a generation which unfortunately have had to go through this. But the silver lining is that a lot of people have actually realized what is important to them, because not just the bad things, right? 2020 came in with some good things as well, be it whether work from home, where people could spend more time with families, people appreciating the smaller things in life. So I think that is something that 2020 has taught us, that you have to expect the unexpected. You can't take your today for granted. Whatever could go wrong will go wrong. So prepare for emergencies. And earlier, when I would tell people that you need an emergency fund, be it 3 or 6 months of expenses, and they'd be like, "Why? This is idle. It won't earn anything." And it would be a little difficult to sort of nudge them to create that emergency fund. But now, I think people are more keen to have more like 12 months expenses and contingency fund, not just 3 or 6 months. A lot of people have lost their jobs or cut down or taken pay cuts. So these are things otherwise which we thought, and people would be over leveraged. Take personal loans, stretch themselves for car loans or home loans, and just buy loads of clothes, credit card spending. So a lot of that, I think people have come to realize that a lot of that is not necessary for us to sort of succeed or to be happy. I think one of the other things that's taught us is not to be overconfident. If you see how the markets were in January versus March versus now. So in March, when we would tell people to invest a little bit more money, they were scared. But now people want to invest more money even at these levels, right? I know people who've actually gone ahead and opened trading accounts and made decent money on stocks. They lose some, they win some, but it's more like trading. So I think not to be overconfident because a lot of stocks have run in this rally. Not necessarily when it falls, everything will fall the same way. The companies that are not good will not bounce back as the companies that are good. So this rally has shown people that everybody can make money. So I think not to be overconfident. Also, when you're not overconfident, you'll put in some plan B in place. So whether it's health insurance or life insurance, I think people need to make sure that that is there, and that they should not just invest in one asset class or one product. I know people who would only be investing in EPF, and including voluntary EPF. So where liquidity can become a constraint, or it may take quite a bit of time to withdraw that money, or a long process. So I think not just invest in one asset class, be it debt or equity. I think you have to diversify. So these are some of the lessons that I think 2020 has taught us, which we can implement for better in the next year.
Okay, so just to summarize all that, Shweta has said, firstly, expect the unexpected. Secondly, don't get overconfident. We have seen a lot of individuals open trading accounts in that attempt to make a quick buck. And, we have seen the markets as well rally. But, that's the thing. When you see that initial rally, you do tend to get overconfident. And that sometimes can lead to ruin. Investing in more than one asset class, equity, debt, gold, so on and so forth. Prepare for contingencies, a plan B, a health insurance and life insurance is a great way to do that, and ensure you implement all of this in 2021. Okay, now if we look at the financial status of an Indian in 2020, we have ended up with high debt, with a low credit score, and depleted emergency savings. So Shweta, how do I sort of get my financial life then back on track in the new year? How do you recommend I get out of, the indiscipline of sorts that I was prompted to take because of the lockdown?
So it has to be slowly and steadily. It cannot happen overnight. You have to manage your lifestyle expenses first. Divide your expenses between the necessity one that you need and the lifestyle ones that you really just want and not need these expenses, right? So divide your expenses. No saving amount is too small, so you have to make sure that even if it's $1,000 that you're saving, it makes a difference. Our mentality today has become, if it's small, it doesn't matter. We like big amounts. So a lot of people that I talk to tell me, I would like to go into an advisor only when I have lakhs of money, lakhs of rupees. So I tell them, if you don't go to an advisor, how will you get to that lakhs of rupees? 1,000 rupees is also good. We don't want to undermine the impact that a small drop has in your ocean. So I think that is definitely something that I want people to know, that even if you're saving a couple of $1,000 a month, it's good. Start with that. If you can cut down your expenses by even 2,000 rupees a month, that will go a long way. And it's a matter of habit, right? So once you start cutting down and start investing that money, you get used to seeing your money grow rather than see the number of things in your house grow. Because at some point, after the initial sort of high comes down, often new dress or new shoes or whatever it is, or new car, after the initial hype goes down, it's just something else that is extra lying in your house and taking up space, and you still don't have clothes to wear. So rather than doing that, save that money, invest that, and when you see your portfolio growing, you will feel happier and you'll feel more motivated to keep saving more and more. So start that. So For people who've taken loans to get through this year, I think give yourself time to be on track. If you've taken loans to sort of upgrade yourself, that's great. You should be getting a better job or something with better pay hike, or even if you're getting the same salary. I know people now have cut down on a lot of expenses, whether it's eating out, whether it's going out, whether it's traveling, vacation. So a lot of these expenses have come down. Don't be in a rush to spend that money. Start saving that money. We have this mental accounting thing where, if we don't spend on one thing, we kind of justify spending it in another place. So don't spend that. Cut down your expenses, increase income if you can. But otherwise, cutting down expenses will increase your savings automatically. And invest smartly. I think we undermine how smartly we invest, because if you're not investing, if you're just saving, inflation is at the end going to take over as well. So make sure you're investing smartly as well.
So Shweta, let's say if you had to curate a portfolio for 2021 based on opportunities you see, the market as it is right now, how would you curate it for an Indian aged between 25 and 40? Let's assume that they want to create a portfolio for long-term wealth creation.
Very general sort of portfolio. I think 40% in equity, because this is for my large long-term sort of goals. It could be large, mid, or small cap, depending on if the investor has experienced equities before. If he hasn't, definitely start with large. And there is no need for you to have all categories of investments in your portfolio. 40% in debt, include your EPF balance in this as well. A lot of times we miss out that. This is the cushion that you have so that your equity portfolio can grow. You can access this. You can use debt mutual funds as well for this, so that there is some bit of liquidity. You can use this for some short-term or medium-term goals as well, and keep replenishing this. Gold at 10%, not just because gold has done what it has done in the recent past, but because we generally recommend 5 to 10% of gold. Plus, I'm seeing younger people today don't have that much exposure to gold. Of course, old 40 plus, if you see people, they do have gold already, whether it's in the family or whether it's physical gold. But youngsters today don't really have gold in their portfolio, and I think that's something that they miss out on. So 10% exposure to gold and 10% in emergency funds, be it liquid funds or be it ultra short-term funds. So this is something that they should keep for emergency at all times.
Okay, excellent. Well, there you have it. Everything that you need to brace yourselves for as you enter a new year. And of course, in a way, correcting the mistakes as well that you may have made in 2020. You may be forced to make very harsh decisions when it comes to your money, perhaps on account of the pandemic, which has affected all and sundry. Well, let's take on board some questions and queries then. And you can shoot them to us on the Money Show at etnow.tv, and we'll try and get them answered. So first up, we have a question from Gaurav Gupta. He says, I'm a government servant in defense, investing 5,000 rupees SIP in Axis Mid Cap Fund and Birla Sun Life Advantage Growth Fund. He's also invested 15,000 rupees in the Defense Services Provident Fund, and he's got 2 flats in Noida worth 50 lakh rupees. He's earning rental income from there of 30,000 per month. He's got a home loan of around 20 lakhs left. He's got an EMI of 27,000, which he's paying. Now, his takeaway salary after, deductions for EMIs, for PF and tax is 1,65,000. Monthly expenditure is just about 13,000 rupees, including the fees of his 2 children. Now, he wants to retire in 5 years. Post that, of course, he'll get the benefits like 1 lakh rupees pension. He'll get a lump sum of around 80 lakh rupees. Plus, he's taken a term plan life insurance of 50 lakh rupees with a 16 grand annual premium. And further, of course, the medicals for defense are covered by free treatment at defense hospitals. His son is already 18. His daughter is a bit younger, 13 years old. He has 7 lakh rupees invested in equity. Now he wants to know financial planning post-retirement. How should he invest the 80 lakh rupee commuted pension amount? So it's a good salary he's earning. He's got his apartments as well, from where he's got a side income, a passive income, that's rental income. He's got the defense PF. He's got his pension and the lump sum commuted pension as well that he will receive. So this 80 lakh rupees, how would you recommend, Shweta, he essentially invests it so that, his post-retirement life is sorted?
So it's an interesting case, right? So Gaurav is earning quite well and expenses are quite less. Also see that SIP is just 10,000 rupees. So I'm quite curious to know where he's investing the others, or is it just lying in savings bank account? But nevertheless, I would want him to figure out what other goals he has, because he's not mentioned anything about children's education further, and their weddings. Knowing this year, I know we are not planning very grand weddings, but there will be something that he will want to spend. So those are things that he should put down as well, not just retirement. If he's getting a pension, if he's getting commuter pension as well, commuter pension is something that we'll talk about, but he's getting the pension as well. He's getting rental income as well, and he can plan his cash flow very conveniently because his monthly expenses are less. So I think it's his case is like a dream come true for most people who are looking at retirement, that there are multiple sources of income. That's one of the things that we do recommend to retired people, that have multiple sources of income. Don't just depend on one. So I'm looking at this as he's someone who doesn't need to take too much of risk. So if he wants to grow his money, he should definitely invest in equity. A small part, it could be 20% of his portfolio in equity, not too much. That could be equity mutual funds, and it could be long term, because even retirement will be there for 2 to 3 decades. And 13,000 won't always remain 13,000. When you have time on your hands, you'll end up spending more money. And 13,000, even if you just keep it as it is, inflation will make sure that it's at least 3-4 times by the time his retirement is over. So definitely he needs to grow that income as well. So equity mutual funds come in there. Senior citizen savings scheme is a good option for him. He could do that for him and his wife as well. Post office MIS is something that most retired people like to invest in. And of course, debt mutual funds, so that there is, he can do like an SWP, and if there's any cash flow requirement, he could do that as well.
Well, Shweta, you hit the nail on the head for one human characteristic, and that is you tend to spend more when you've got more free time. So yes, it's important to note that just because you spend maybe a little frugally now, it does not mean that your expenses will stay low going forward as well. Okay, next up we have a question from Vijay Lakshmi P. She says, I'm 45 and I would like to accumulate a corpus of 1 crore for my retirement, which we would presume would be 15 years or 15 to 20 years from now. She says, she asks you, Shweta, if you could check if her portfolio is good for her to reach that goal. She's in fact investing not once but twice a month. So it's an SIP of twice a month. BOI AXA Tax Saver Fund 3,000 per month. Parag Parikh Long Term Equity 4,000, Motilal Oswal Nasdaq 1,000, Axis Midcap 1,000, Quant Small Cap and Kotak Gold Fund 1,000. Most of her funds are quite are winners really. Axis Midcap done well, Motilal Nasdaq, Kotak Gold, the BOI Tax Saver as well. Now she wants to know that she's I think already invested 11,000 per month on an average. So what should be her total SIP amount to reach her goal? Shweta, what do you think of the mix of funds? And also, do you think 11,000 per month for the rest of the 15-20 years that she has is enough for her to reach her corpus of 1 crore? And I would like to actually ask you one more question. I'm not sure how Vijay Lakshmi has come to the amount of 1 crore rupees. Maybe she has some other money as well lying with her, which is going to be used for her retirement. But I think it begets the question that how do individuals reach a figure that they think they will need for retirement amidst the good longevity of lives that individuals live thanks to good medical care, etc. It could be a little tricky really to think that you will be able to live the remaining 20 years in 1 crore.
Absolutely. I think that's a question most retiring people don't ask. Most people don't ask at all. And we think that just because we are retiring, inflation retires as well. It doesn't happen like that. So if she wants to retire in, say, 15 years, she has to invest 20K per month, at least from today, if you take to get to that 1 crore magical number. And I think there's no math really behind this. For most people, the crorepati tag is important, while it really just depends on a couple of things. When is she looking at retirement? How much does she spend? What are her monthly expenses, and estimating that post-retirement as well. And third is that, what are already existing investments. So these three will actually decide how much she needs to invest per month and how she should invest that money. The schemes are good, but there are too many schemes. What I also see from her portfolio is that she has one scheme in every category of schemes. There's one gold fund, there's one small cap, there's mid cap, there's an international fund, there's a tax saver fund. So it's basically every category which is chosen and taken one scheme. So I'm not a fan of that because say small cap was to do really well. Her exposure is just so small that it won't make a material difference to her portfolio. I would recommend that she can say cut down small cap and just keep investing in these other schemes and not necessarily add any more categories or schemes. She should build a good core portfolio first. So your large cap blue chip type companies, and then add on to the other categories. I think the tax saver fund is fine. She's putting 3,000, keeping in mind the ATC benefit, I presume. Parag Parikh 4,000 is absolutely fine, but maybe she should then build on mid cap, so increase the mid cap exposure at least to 2,000 because small cap is then going to cut down. And then go to gold and Nasdaq, she can keep maybe 1,000 each. I don't also see the need to invest twice in a month. She can just invest once a month. There is no research that has said that if you invest twice in a month, your rupee cost averaging is going to be better. In fact, our analysis we've done, it doesn't make any material difference. I think once a month is good enough. Twice a month just means more transactions and more things to keep track of. So she can change that to once a month as well.
Okay, well, there you have it. That's, of course, advice coming in from Shweta on how you can essentially reach your goal. And, of course, asking yourself the question realistically how much you will need for retirement, because inflation, like Shweta mentioned, does not retire when you do. Okay, Shweta, on that note, we're out of time, so we leave it at that. Thanks so much for joining us today on ET Now and, helping our viewers out as well with their questions and queries.
My pleasure, Nidhi. Thanks.
Okay, well, moving on, here is an interesting piece of news for those individuals who have loved using their digital platforms to invest in the equity markets, to invest in mutual funds and whatnot. There's a SEBI notification that has eased the norms for fintech firms to launch an AMC. What is an AMC? It's essentially an asset management company that's behind these mutual fund schemes. The sponsors that don't meet the profitability criteria can still apply. The move will essentially help fintech firms, your digital firms, to seek a mutual fund license. Of course, there are certain parameters that the fintech firm should have a net worth of roughly about 100 crore rupees, and it should also record 5 years of continuous profitability. Earlier, it was difficult for these fintech firms to launch mutual funds of their own. There used to be the minimum criteria of a net worth. There's also the profitability criteria. But now there are other norms that have sort of been eased. So you may perhaps see your digital platform companies, the companies that offer you platforms to trade, invest, track your stocks. They may now launch mutual funds, and you would be able to invest in those mutual funds, do an SIP in them, redeem them whenever you want, so on and so forth. Of course, it's very early days yet, so I guess we'll wait for a little while for a fintech company to announce their foray into mutual funds. Okay, well, on that note, we'll take a very short break on the show. Don't go anywhere. We'll be back with more.